Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and in tonight's free video I wanted to discuss a little bit more of the butterflies that I've been using around earnings. So two good examples of that for today are going to be CRUS and CVX. Now the first of these, and I always like discussing the pros and cons of each way of looking at these, because John had made a suggestion that he was looking at a strategy here, simply selling the 53 put and then buying the 50 as protection, just a standard short put vertical. I opted to come in and do an unbalanced fly, and in this case he would have actually had the more advantageous strategy, but the reason I did it the way I did is because I wasn't really just thrilled about this chart, and I like the idea of saying, okay, I'll get along with the bullish thesis and go that way, but in case it doesn't just go straight up, a strategy like this will actually work a little bit better by having the additional 52, in this case the 52 put. So what the unbalanced fly is trying to do is say that as long as you stay above 50, that's great. We'll still make money because we took in a credit on this initial transaction, but I will make less of a credit than if I had just outright sold the put credit spread. Now the risk on this is a little bit different as well, and I tend to find that that's a little bit more advantageous for what I like to do, but you know, in this case the short vertical would have made you a little bit more money. But then coming over and comparing with the second example that I wanted to show with CVX, now he didn't make any type of a recommendation on this, but I didn't want to be just outright bullish, but I didn't really feel like shorting it, and this is another good spot to use the exact same strategy. So in this case, using almost the exact same idea, and just looking at the idea of selling the $100 puts and doing that to a degree that it helps compensate for the put that you are buying. So you're selling the bulk of the 100s, buying the 101, and also buying the 99 in case it were to continue to come down. Now spots like this are great to discuss this strategy because where we're trading here after hours is exactly what I would like to see. You know, this is a strategy that by taking in this 12-cent credit, if it jumps up after earnings, well then you just take in that credit, cover your commissions, and it's kind of a non-event. But if it can come down here and trade closer to 100, well then that's where you've got the intrinsic value of the 101s still selling the psychological area around 100, which hopefully it will hover near tomorrow, and then if it can stay stuck to that level, should really work out pretty nice. On an initial 12-cent credit, you can make $1.12 while you have 88 cents at risk, and I just really prefer those as to the outright put credit spreads in those types of spots. So I hope you found that helpful. If there's anything else I can do to help, please let me know, and I will see you at the next free video.